Hello traders, Gary Wagner here. It is 12:28 in Honolulu, 6:28 in New York on Friday, 15th day of July 2022, and this is the Daily Report for Gold and Silver, our weekend review. Gold closed out the week with fractional gains today. The August contract of gold futures gained 70 cents and is currently fixed at $1,706.50. Silver had a very respectable gain of 2.39% or 43.5 cents, with the most active September contract currently fixed at $18.66. All precious metals were aided by dollar weakness. The dollar gave up just over 0.5% and is currently fixed at 107.825. This first chart is a daily chart of gold futures, and the topic on many traders' minds today was whether or not this current level of lows at 1700 could provide a price point in which gold finds support and then begins to trade higher. The primary reason we have seen gold fall from its high in March down to recent lows just below 1700 is interest rate hikes by the Federal Reserve. This most recent round and selling pressure in gold has been a direct result of the CPI report that came out this week, showing that inflation continues to ratchet higher, now at 9.1%. This has led to speculation that the Federal Reserve might enact a rate hike of 1% at the end of this month rather than 75 basis points. And because of the uncertainty as to how much the Federal Reserve will raise rates by at the end of this month, I have to move to technical studies for more insight. When we look at this chart, what we can see is that clearly $1,700, at least over the last couple of years, has not been a price point that resulted in price support and a bounce off of that price. In fact, over the last three occasions, here, and here, each occasion, gold prices went from above 1700, broke below that. However, it did not find support till about $1,680. And it is for that reason that the most logical place to look for real price support isn't $1,700, but rather $1,680. Our premium subscribers know that we sent out a trade alert to buy gold at a specific price, a limit order, and also where to place that stop. That's based on the fact that we do not believe 1700 will hold. In fact, the only technical study that indicates that 1700 could be a potential area for price support is to do a Fibonacci retracement from a much larger data set. The retracement we have been using begins at 1680 and concludes at 2078, and that is the bottom of the range, 1680. However, if we do a much longer data set, this begins in March of 2021 and goes up to the record top at 2088. In that case, we get the 61.8% Fibonacci retracement level coming in at 1695. However, there's a large caveat to looking at that price point. In any point in time in which we saw potential bottoms around 1700, on both occasions, we had a series of lows that came in well below 1700 and actually touched upon 1680. To me, that strengthens the assumption that 1680 is a logical price point for support and not 1700. Traders, maintain your current limit order as well as your stop. That is available on your members page. Next week, we will focus intently on the current speculation as to the size of the rate hike. This has been Gary Wagner wishing you, as always, good trading. We will talk to you on Monday for the next daily update and review. Bye-bye.